Now on Sky News Business, this is Your Money, Your Call.
Tell me about things with you, how things with...
Going very well. On the domestic side, we've had a better 6 months than the last 2 months.
Yep.
We've actually, remember, we've got a lot of cash because we can't find value in the market. We'll talk more about that tonight. So our cash has been building up. That acts as a drag when the market rallies.
Yep.
But in the last 6 months and over the last 2 months, we've matched the market's return, which doesn't sound impressive, but if you remember that we've got, in one fund about 25% cash, in another fund, one of the domestic funds, we've had as much as 40% cash. That's a big deal to do as well as the market.
75% and your 60% have really shot the lights out. You haven't changed
Correct.
The cash component.
Yeah, so the invested part has done very, very well.
Yep.
And on the global side, the global team's absolutely shot the lights out. And they're just starting to, their cash is just starting to creep up now. And on the long-short fund, which is the Montgomery Global Fund, the net exposure is actually now starting to decline.
The net exposure?
So if you take the longs and subtract the shorts,
Yep.
you've got your net exposure.
Yep.
So
you're increasing your shorts?
So the shorts are increasing, the net
Yep.
exposure is going down, exactly.
Sector-wise, what are you shorting are you talking US?
We don't look at sectors, we're looking at individual businesses that we believe meet the criteria for our short framework.
Okay, this is the bond show, so let's just talk about equities. I want both of your opinion on the reporting season, so I'll start with you. How did you think about that reporting season that we are party to? Do you look at the Australian economy glass half full, broadly speaking, everything's doing well? Or how
at the moment we're in the goal. The reporting season showed that with the exception of a couple of sectors, retail being one of them, most of...
That's going to be a dirty word soon, or like what, retail is going to be...
Well, there'll also be amazing opportunities, remember, because the baby will be thrown out with the bathwater. Even if Amazon takes $4 billion of retail sales in Australia, which will amount to a little bit less than 20% of online sales, and probably, a couple of percent, maybe 2% of retail sales in total, and if you take out $73 billion of supermarket retail sales from the total retail sales figure, it might be about 4%. There's still a big retail sector. Amazon doesn't kill everything.
People like to shop.
And there'll be a lot of opportunity. So companies will be affected, and in some companies there'll be divisions that do worse than other divisions. So for example, in Super Retail Group, the Rebel Sport business might do worse than BCF, for example, which is the boating, camping, fishing.
Of course it is.
Yeah.
I told you acronyms, I'm really good at it.
Yeah, well, I'll always tell you what the acronym means.
Thank you.
So don't worry about that. I'll make sure I do that. So back to reporting season. We basically saw a lot of companies report reasonably good results because they were backward looking. They're not looking forward. So we think property might do it a bit tougher. We think retail sales will do it a bit tougher. We think that that rent from retail REITs will be under pressure. But all of that is forward-looking, not backward-looking. So the last reporting season was actually okay.
I want to clarify, he said rent from retail REITs. You don't want to say that,
REITs.
You don't want to say that too quickly.
Real estate investment trusts.
No, that's fine. A real estate investment trust. But remember, we've had a thing with Avi Anger on the show about REITs and the diversity of REITs. So you can have retail, custom companies that are...
Industrial, office.
Yes, exactly. You can have all sorts of different REITs. So don't just throw baby bathwater REITs.
But you don't have any residential real estate investment trusts in Australia because there's no income available from them.
He doesn't like the Australian property market. Now, tell me, let's say CBA have, I don't know how many people they've got, 50 or 60,000 people working for them. It's hard to define that as a culture. I think Montgomery has a culture, smaller organisation. So how do you think about it, both of you?
And it's difficult. The culture is always from the top down. There's no doubt about that. Fish rots from the head.
So Andrew Rev seemed like a pretty good guy. He said to have pretty good culture. He said the problem was I can't move it into the broader system.
The difficulty is in an organisation as big as the Commonwealth Bank, you really would have to be, a Richard Branson, Steve Jobs type of Mark Todd, guru to have an influence that really permeates the entire organisation. remember, you've got, in each division, you've got a head. In each division, you've then got, subdivisions that also have people who are reporting to the head. And so, there's a culture within each of those silos. And it's very, very hard in the time frame that a CEO typically has in a large publicly listed organisation to change the culture. It's easier actually to change the direction of the business, which is frighteningly difficult, than it is to change the culture.
Tell me your interpretation of what Judith was saying around the board. How do you see the impact of the board in the business? Are you consistent with that, saying, okay, I think they have got a... Well, how would you think they can play a role in that change in culture? Anything at all?
Well, when a boat is adrift, everyone looks to the helmsman to determine, to determine what do we do next. And so they're looking for some guidance. They want to see some leadership, and that's an important function. But again, how do you track culture? How do you measure culture? You can measure financial performance much easier than you can measure culture. How do you remunerate people for contributions to culture or for detracting from the intended culture? Very, very hard in a modern environment to actually say, do you know what, Mark, you don't fit our culture. You have to move on.
Yeah, you can't do that. You can't do that.
You can't do that.
No.
You'd like to be able to do it.
No, you just got to work through. You've got to agree. What's the culture?
Well, there are some people that have been hired that don't fit the culture.
Yeah.
But you can't just get rid of them because they don't fit the culture.
But
right? So it's very difficult.
I mean, Orica, they got rid of the CEO there because he was wrong for the culture, and the board was pretty clear on that.
Yeah.
So, I mean, it does. The tone.
I'm thinking the other way around. You're the CEO, you're instilling the culture in the organisation, and you've got people from the old culture that don't meet it. It's a difficult problem.
This is a good story.
We
have to take a first break tonight. I'll talk a little bit more about this because I want to get an understanding of what directors can actually do in the business when the business is rapidly changing. So who is the director at charge? You. So I guess I'm going to try and paraphrase what I was talking about in the ad break.
Go for it.
How do you think about
you want me to
challenges that retail offers when you say, who's the right director to give me direction on retail? So, in other words, your point was they will work it out, but how do you know who's going to be the ones to work it out? Because this is foreign territory.
Well, that's the issue, that the changes that are occurring in retail now are so rapid and often brand new challenges that haven't been faced by retail before. And so you're not only seeing a change to the competitive landscape, but you're also witnessing a change to the way the customer engages with a business. And so that's all happening at the same time as new foreign businesses are coming in with very different business models. You've got a legacy business model that may not be competitive anymore, but it's generating revenue. If you stop that to go for something else, create a huge revenue hole. Fairfax found it very difficult to let go of newspapers. They're still printing those newspapers, even though arguably losing money on them. So, it's very, very difficult. Very, very difficult to let go of a legacy business and transform yourself. And that's why a lot of businesses in the recent past, the real threat has come from two guys in a garage coming up with something new. And it's a cliche, but deliberately so. They were the ones that had nothing to lose and everything to gain, so they worked really hard at doing something disruptive. Now we're seeing the biggest companies in the world, the Amazons, the Facebooks, the Googles, the Apples, they're the disruptors. They're the ones that are the most disruptive, and they've got very deep pockets, very patient shareholders, and very supportive shareholders, and they're the ones causing the most commotion. It's really, really challenging. And in the meetings that I've been to with management of retail businesses in Australia, it's rare to find someone that actually has an answer for how to respond.
So do you just stay out of that segment?
We're not in retail at the moment at all. And I had lunch with some private equity people today.
Oh, that would be boring.
No, it was fascinating.
Really?
Actually.
They always talk their own book.
Well, it was a bunch of very,
I'm super smart, I make a lot of money, and this is really cheap, and I'm going to buy it.
It was a bunch of people in private equity who were strong Christians. It was actually a Christian lunch, and all these private equity guys. But what was interesting,
Christian private equity.
I know,
I want to
it
go
feels
to that.
like a sort of,
I want to
oxymoron,
be.
but
I want to
anyway.
be a fly on that wall. I want to know what they're buying.
There are people with integrity in all different sectors of the economy
Clearly,
and market,
especially at the NAB.
So what was interesting about that is the private equity guys I spoke to are out of retail as well. They have the time to have bought retail was 10 years ago,
Sell it at
not
9.
today.
Yeah.
So right now you need to see how the dust settles, and that's our conclusion at Montgomery. We want to see how the dust settles before we
But there's lots
look
of
at
retail.
investing.
I personally think the quality of advice since the GFC has improved. I think that's true. I mean, would you disagree?
No, I wouldn't disagree. I think the quality of advice. We in our role as fund managers, we're always describing or explaining our performance to financial planners. We're pitching to financial planners about why we'd suit their portfolios. And I've noticed a significant improvement in the quality of the financial planners that we're seeing. Now, that could be because the subset of planners that we see who are interested in us are the better ones.
Your cohort's worse, but
we could see.
I think it's more.
I think generally they're better, and changes to legislation have ensured that they have to be better qualified.
Yep.
So they have to get up to speed pretty quickly. I think it is very, very difficult for a retiree, someone who's said, okay, I'm going to retire in January, this is my last year of work, and I'm going to start looking after my finances.
That's late.
And I'm going to invest in shares with no qualifications whatsoever.
Don't do that, folks. Don't do that.
I would, knowing what I know about investing, I would think you're on a hiding to nothing. You've got a very, very difficult path ahead of you. And, I've seen it with doctors and dentists who believe that, hey, do you know what, I've taken 12 years to learn my craft and to become an expert at it, but I can learn to invest in shares by reading a book.
Yep.
It'll be that easy.
We have to take a short break. In one respect, there is definitely the opportunity to use ETFs and the like for a period of time if you want to access. So one of the things that guys at NABTRADE were telling me today, the most dominant ETF that they have got right now is a US dollar ETF. It's just literally a currency. So people are taking a view on currency. So I get that. That makes it easier.
Yeah, it's a
you go and buy that.
trade.
So I like that piece.
Well,
I think buying
what I don't like
indices that are stock related, like the whole indices, that's hard.
Let's just take the ASX 200 for a minute.
You can take it.
48% of that market, 48% of its weight is attributed to 15 companies.
Okay.
Okay, 15 companies, and that's the banks, BHP, Rio, there's CSL in there, Macquarie Bank as well. But with the exception of maybe CSL and maybe Macquarie Bank and maybe Coles and Woolies, all of them are either cyclical or their next 5 years are challenged more than the last 5. So overlay on top of that the fact that the majority of their earnings, the top 15 companies, the majority of their earnings has been paid out as a dividend. And you've seen the payout ratio go from something like 55 or 60% to over 80% since 2010.
All her retail shareholders,
Right.
and they need the money.
So then, if your payout ratio is 80%, it means you're only retaining 20% of your earnings for growth.
Yep.
And guess what? You're not going to grow very much. If your return on equity is 20% and you're retaining 20% and compounding 20% at 20%, you're growing at 4%.
Yep.
That's it. And if you have a look at the ASX 200, only this week it hit 6,000, which is where it was a decade ago. And so it has, in 10 years, it's gone nowhere. So why? Because big companies, mature companies, not reinvesting for growth, but paying most of their earnings out as dividends, and so you're not going to get a great return. But people invest in the index. The index, well, I'll finish on this point, the index wasn't designed, nowhere in Standard & Poor's document that says, index construction methodology, they've got a document that actually explains the methodology for constructing the index. Nowhere does it say, we've constructed an index to give investors a good return. They've said, we've constructed an index to track activity in the market.
Yep.
And that's all it is. But people invest in it believing I will get a great return.
No.
And you can go for long periods with no return at all. I think that's absolutely fundamentally correct. that risk has not been priced appropriately.
I completely agree, John.
And
it is.
And that's because interest rates have been so low for so long that investors have deliberately, by central bank activity, been forced up the risk spectrum or up the risk curve to pursue a higher yield. But now, you see, for example, corporate, high quality corporate credit in the United States is now earning less than 1% more than US Treasuries.
Yeah.
Right? And you look at, Argentina, I know we talked about this last time we were on the program. Argentina just issued a 100-year bond at 7.29%.
Yeah. That's different.
I know you say it's different, but
It
think
is.
about
It's a different. It's not this world. It's not. That is
not our client's world.
But it's also there's opportunity. Okay. Here's the key to a lot of this stuff. When you buy something, you need to work out how to get out of it. It doesn't necessarily mean you sell it. You can sell other things. Argentinian bonds is something else. That's where they do the credit default.
So triple C rated credit.
No,
well, hang on. Let me finish. So triple C rated credit.
I'm trying to get.
I'm just coming back to the question from the.
You're
person.
right, John. It is mispriced.
Correct. So you've got this massive compression in yields, and this week I had lunch with a former governor of the Federal Reserve in the United States, and he was telling me it's something that they completely didn't expect. The magnitude of the compression of yields, whether it's triple C rated, whether it's sovereign, whether it's corporate.
It is. It's a worry.
It's a real worry, because if you can't see risk around the corner, and there's nothing around the corner that anyone's worried about, if you don't perceive risk around the corner, you can't price it. And so the yields have been compressed, and you're now getting a return in some cases that doesn't compensate you for the risk. So on a risk-adjusted basis, cash is actually better, because it gives you, yes, it's a lower yield, but the risk is much lower. And so you're actually on a risk-adjusted basis better off in cash now. How
has your business changed in response to the desire for the service proposition? How is it changing now since when you first? You've had two, so
yeah. So we've focused very much on educating investors, believing that we would rather have highly educated investors as our clients than people who wax and wane with the changing direction of the wind. That wouldn't be good for our business, because we have a long-term value investing proposition, and inevitably our style, our philosophy, value investing, will go through periods of underperformance, and arguably 3 years out of 10 we'll underperform the markets, but in the long run we'll outperform, and in fact that's been our experience. So we want investors who understand that, and they understand why that's going to happen, and so education has been a big part of our strategy and our brand building. The other thing I'll say is that we've combined machines with humans, so cyborg, investing.
Cyborg,
we have, I like it too. It sounds very Terminator,
cyborg,
doesn't it? So Tim Kelly on our domestic team has been instrumental in developing some intelligent programming that actually learns as it invests and finds things that work and finds factors that work in the market and that are powerful, and then re-weights those factors to identify things that our investment team should look at. And so we've combined AI, if you like, with human overlay.
Since 1990, I spoke about this last week, since 1990 the VIX has closed 48 times below 10.
Yes.
Since 1990. And now, on Wednesday, 39 of those 48 times had occurred in 2017.
There you go.
Is that something that we should worry about? That's just central bank story. Is that something that we should worry about?
So I'll go first.
No,
that's okay.
I'm going to leave it to you entirely.
Okay.
We're about to go to an ad break, so we can just run it through to that.
So investors are believing in a false sense of security. If you look at the S&P 500, it's delivered very high returns over the last 12 months with very low volatility. So the Sharpe ratio is 1.4 or 1.45, which is something a hedge fund manager would give a tooth for, to try and achieve that Sharpe ratio consistently. The index in the United States has done that. People think it's normal. It isn't normal. And Robert Shiller recently wrote an essay talking about, when the next crash might actually occur. Robert Schiller being the inventor of the...
Don't panic yet, folks.
Talking about...
Robert Schiller might get it wrong.
No, he didn't say there would be one soon. He just said, he just posed the question, when might it happen? And what he was saying was the Cape-Schiller ratio, the Cape ratio is very high at the moment, so it's actually at 31 times. In other words, the inflation-adjusted index is at 31 times 10-year average earnings, which is extraordinarily high. In fact, since 1871, it's only been this high once before, and that was during the tech boom in 1999, early 2000.
Yep.
And he said, but analysts are saying, yes, but Robert, volatility is very, very low. And when he went back and looked at the last 13 bear markets, which he defined as being a 20% correction within 12 months of a previous peak, there were 13 since 1871, and he said in all of those situations, in every one of them, volatility was extraordinarily low. And in fact, before the great crash of 1929, it was lower than where it is today. We haven't said that ETFs stand for Exchange Traded Funds.
Thank you. Another acronym.
Yeah, another acronym. So, so the concern that I have around them at the moment is that a lot of money has flown into ETFs, Exchange Traded Funds. The liquidity offered by the ETFs is often greater than the liquidity of the underlying securities, which is fine when the market's going up.
Yep.
Because money flows into the ETF, it takes time to invest, and then you invest it in the stocks and they go up. What you're finding now globally is that some of these ETFs are so large that it doesn't matter whether they've got a quality bias or a yield bias or an income bias or a momentum bias, whatever their philosophy is, they've all got the same stocks. They've all got Exxon, they've all got Apple, they've all got Google, and the problem is that, one of them, the SPY, which is the S&P 500 ETF in the United States, it's invested, its biggest holding is ExxonMobil, which has 90% stock turnover in a year, but the ETF itself has 100% a week. So when the market goes down and people want to pull their money out, what happens?
Okay, good point. Peter, so the key to it is have a strategy and be mindful of what you're investing in. So his point is, you don't know what you're investing in until you've actually done the work. So yes.
Dealers should seek their own